The idea that a recession or a slump is going to lower prices and therefore interest rates are going to come down. I know everybody thinks that within the establishment, but it is completely false.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin specials for December 11th through December 18th, 2023, while supplies last. First, we feature 1 10th-ounce gold maples at just $30 over melt with a minimum order of 5. Next, we have silver eagles at $4.99 over spot, making this a great time to swap silver bars into silver eagles at the lowest premium in years. Finally, constitutional 90% silver is just $3 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance, everyone. Thank you so much for joining us today. With us today is our good friend Alasdair Macleod from goldmoney.com. Alasdair, thank you so much for joining us today.
Thank you for asking me, Elijah.
Well, it's great to have you. Our viewers always appreciate our interviews with you. We would like to discuss today first the gold market, because last time we had you on, you were saying that gold was setting up for a run, and it seems like we saw that. We definitely saw, last week, that breakout above that $2,100 level, and we've seen kind of a disappointing correction here. I guess that's part of the move, is it can't go up in a straight line forever, but your take on what we're seeing right now.
Yeah, I mean, it's actually quite a normal tick back. And if you put it in the context of the paper markets, remember that the bullion banks and other members of the swap category on COMEX basically run short positions. Their short position was increasing very rapidly. And they had the further problem that normally there would also be producers running hedging positions in the market. So, but they're not. I mean, the level of hedging is as low as it's been in a long, long time. So the result is that the swaps are having to deal with the bulls in the market on their own, and for them it's a potentially dangerous situation. I mean, quite obviously, as soon as it was going to go through 2000, you could see that everybody, hedge funds and all, the momentum chasers and all the rest of it, they're going to go in there and buy it. Of course they were. So they needed shaking out. And it's if you like, a normal process. As you rightly say, nothing goes up in a straight line. But having said that, in my market report for Gold Money last week, I suggested that it would be perfectly normal for the gold price to tick back to around about 1950, which is where the long-term moving average was. And on that basis, that, if you like, would be the platform for gold to really start moving ahead. But I want to emphasize that we're actually looking at this the wrong way around. It's not gold going up, it's the dollar going down. This has been very much, excuse me, this has been very much the case with other currencies, while the dollar was strong, as it were. But now that the dollar seems to have turned some sort of corner and is weakening, is the fate now being faced by the dollar as well. And I think to put it in context, people might find it a little difficult to imagine why gold should run to, say, I don't know, let's pick a figure, 2,300, maybe 2,500 or something like that, or talking about some sort of reset. But I think the right way to look at it, which would explain everything for people who can understand this, it's not gold rising, it's the dollar falling. So if you turn the price upside down and think in terms of what's going on in the dollar, not gold, you can begin to understand the circumstances whereby the dollar rapidly loses purchasing power, which would be reflected in the gold price. And then, if you talk about the dollar maybe losing a quarter or a third of its purchasing power, I mean, the conditions are there for that to happen, even before foreigners intervene and decide to dump the dollar. You can begin to understand why the gold price, if you like, would reflect this at a far higher level. And I think what's developing in fiat currencies is actually just that situation. We're beginning to see these fiat currencies, in other words, credit, which depends on faith in that credit and nothing else, that is beginning to lose credibility. And this is probably slightly at odds with the, if you like, the chatter on the street about interest rates and things like that, and how they're going to ease and how we're going to go into recession. So prices aren't, inflation's going to start going back to 2, and you never know, they might have difficulty holding it above 2%. You've got all this sort of chatter which rather militates against that. But if you actually understand that we're talking about credit which has no anchor in value, and we're talking about, in the case of the United States, a government which is running a deficit in this year, which I estimate will be probably 3 trillion. It could even be more, because roughly half of that is interest payments. That's got to be financed. How is it going to be financed? What sort of yield is it going to be financed on? Well, I mean, the answer basically is that with foreigners showing signs of standing aside, funding that is going to be extremely difficult for the Fed. And I think that we can talk about inflation rising again as the dollar weakens. We can talk about foreign perceptions of dollar values, which are likely to deteriorate. And we can start to think in terms of what sort of level of bond yields are required in order to get away the refinancing of $7.6 trillion worth of maturing debt, and on my figures, which I've just stated, another 3 trillion on top of that. So we're looking at over 3 trillion, over 10 trillion of bond financing that needs to be done in this current fiscal year. These are major hurdles, and at the moment, I don't think anybody's paying attention. I really don't.
You're making the case, obviously, for an inflationary future, which would be bullish for gold. We have a viewer here, Bob Allen, wanting to know, if we see a recession next year, could we see disinflation? And he's saying that would be bearish for gold. So what is your counter argument for, if we see a recession, then we're going to see deflation?
Okay, well, the first thing, I think there's a bit of a misconception there, Bob. Think what happened in the Great Depression. What happened basically was that the gold price went up, both measured in terms of goods. And this was recognized when, I think it was January 1934, they devalued the dollar against gold to try and stop prices falling, as it were, intensifying the depression. So actually, in a recession or a slump or whatever, the purchasing power of gold rises. So I think that's the first thing that we must get straight. The second thing is that where are we in terms of the recession? I believe we're already there. I know that GDP looks as if it's growing, but bearing in mind that the government is injecting probably something like 1.5 trillion into GDP, because virtually all government spending, not non-interest spending, I'm referring to, goes into GDP in the form of, suspending of welfare commitments and, government contracts and all the rest of it. This is not financial stuff. This is pure GDP. If you take out 1.5 trillion out of GDP between, let us say, the outturn for the last fiscal year to end September, to the expectations of GDP at end September 2024, then you're going to see that actually the nominal GDP is either not rising or is likely to fall. Now, on top of that, you've also got the expense of refinancing government debt and all the rest of it, and that's probably going to work out around about 1.5 trillion on my figures. Now, that compares with last year, which was a little under 1 trillion. So we're talking about a 50% increase in the cost of funding as well. So what I'm trying to say is that any growth in GDP is actually purely government. It's not the productive side of the economy at all. And the confirmation that you'll get that this is the case, you go and talk to anyone throughout America, the small businesses, how tough conditions are, how the banks are not, if you like, bolstering your cash flow by giving you overdraft facilities, how medium and small businesses throughout the land are suffering. And when you look at things like, lending officers' surveys, I mean, they're all no lending, forget it. You don't come into the bank and ask us to lend you some money. What the banks are doing instead is they're lending money to the government, particularly through short-term loans, in effect, treasury bills and that sort of thing. That is how the government is funding itself at the moment. And that funding is costing it roughly 5.4%, 5.5%, something like that. This is expensive funding. This is why the interest rate bill is so high and going to continue to be so high. So all in all, we are seeing an economy that is already in recession. The idea that the prices are going to fall is wrong. I mean, I've just made the point about prices measured in gold. And so, gold's not going to suffer in this at all. The other point is that economists talk about, falling demand. But what they don't understand is that the reason you get falling demand is because businesses respond to the conditions basically by cutting back their operations and therefore cutting back their output. That happens first. They then make people unemployed, and it's the unemployed who are meant to no longer demand goods. Yeah, but I mean, the goods are no longer being produced. So this idea of a general slump, it's a pure Keynesian myth. It's called Say's law, which basically describes the division of labor. This was something that Keynes dismissed so that he could invent macroeconomics. So I urge you, Bob, don't listen to that rubbish. It's just untrue. The idea that a recession or a slump is going to lower prices and therefore interest rates are going to come down. I know everybody thinks that within the establishment, but it is completely false, as we saw in the 1970s.
Now we have a couple of viewers' questions on the banking system, and this obviously relates to interest rates that you are saying are going to probably stay higher for longer. When it comes to the reverse repo facility, we have a viewer asking, Larry wants to know, what do you think will happen when the reverse repo facility dries up? Now we've heard projections on this that it'll fall to a critical level around March of 2024. Your take on that?
Well, I wouldn't worry about that at all. I mean, if the reverse repo facility disappeared, it wouldn't really make any difference. What is actually happening? I mean, I've seen, people tweeting, sort of bizarre stories about, what happens if the repo, it's declined from 2.5 trillion down to 600 billion, or I don't know, whatever. It's irrelevant. The reason that the reverse repos came into existence in the first place is because under Basel III net stable funding rules, big banks or any banks are penalized from taking big deposits, because the idea is that if you're dependent on big deposits and the big depositors decide to take their money out, it creates a funding crisis for you. Bizarrely, the people who would normally produce a run on the banks, in other words, the small savers queuing up round the block to get their money out, they're the safest of the lot under this situation, according to Basel III. I'm not going to get into that argument, but anyway. The problem, therefore, for money funds is that they couldn't really go into money markets in order to invest, as it were, simply because they couldn't find the bank counterparties to take them on as, take on their funds, if you like, in the form of deposits. Because if a bank goes into the money market and bids, and bids for credit, then, this is going to end up as deposits on its balance sheet. That's the whole idea. Basel III said, don't do it. This is not a good idea, not a good basis for you to fund your assets on the other side of your balance sheet. So that was what drove money funds basically to move money into the Fed. The Fed created the facility because the Fed could see that this was a problem, which is why instead of just dealing with the banks, it then turned around and said, OK, we will deal with an approved list of money market funds as well. And that opened up the reverse repo facility. So that's what all that was about. Now, what has happened? The big question is, where has that gone? It's gone from $2.5 trillion down to, I don't know, less than $1 trillion. And it certainly hasn't gone onto the big banks' balance sheets. No, well, the answer basically is that a money fund going into the treasury bill market can get 5.4%. That's where it's gone. It's all gone in there. So the US government actually has got this temporary situation where it's got no funding problems as long as it's prepared to pay 5.4%. And that's where it's gone. So the concern, I think, isn't that this is a sort of sign that the whole financial system is in trouble or anything like that. No, what's happening is that the US government is funding itself off short-term debt. The more it does that, the more it creates a problem for the future. So that as interest rates rise, as I'm sure will become obvious as we go on with this podcast, as interest rates rise, the US government is going to be exposed more rapidly to the rise in interest rates than it would otherwise because of its increasing reliance on short-term funding. That's all that's happened. So don't worry about the reverse repos.
And it's not just the U.S. government. It seems to be, as you've mentioned, pretty much all the G7 nations are in this sort of debt trap. Did you want to expand on that?
Yeah, absolutely. I mean, debt trap is the right word. It's the sort of situation where you find that rising interest rates increases the interest bill, and governments find that with the recession coming along, they've got greater and greater welfare obligations, and they've got to maybe rescue big businesses, which would otherwise create massive unemployment. All these sort of things militate to a situation which was rather like the one Germany found itself in when France walked in and took over the Ruhr back in early 23. What do? Well, I mean, basically, the government ends up paying for everything. And how does it pay for it? Well, it just prints it. It just goes into overdrive. And, these rising interest rates, and they will rise after this dip. And I'll explain why in a moment. But these rising interest rates, just like it's a debt trap from which there is effectively no escape. I mean, I just cannot imagine a situation where any politician has the mandate to really cut back on public spending, to refuse to raise things in line with inflation, sort of welfare payments and so on and so forth, which are linked to inflation or seriously meant to be linked to inflation. They've managed to kill that one a bit by fiddling the inflation figures, but anyway, that's another story. The situation of a debt trap is that once you're in it, it's very, very hard to get out of it. And no politician has got the mandate to support the moves in order to achieve that. And it's not just America, it's all the other G7. I mean, Canada, UK, France, Italy, Germany, and Japan. With the US, that is the 7 members of the G7. And I mean, Japan, no wonder they're sitting on their interest rates, keeping them negative, because they've got a debt to GDP figure of 260% or something like that. I mean, it's just absolutely incredible. This is government debt only. I was actually looking at these figures earlier. According to the IMF, at the end of last year, US debt to GDP was 122%, Canada was 107%, UK was 98%, Japan 261%, France 112%, Italy 144%, and the only good guys in this are Germany at 65%. Now, I should say that last time we were in this sort of 1970s stagflationary type situation, the UK had to be rescued. It had to be, the IMF came in and made a loan. And fortunately, what it did was it insisted on controlling government spending. It insisted that taxes had to be raised, etc. I mean, all these things which the Keynesians would say absolutely crazy at the time of recession. You mustn't do this. Anyway, it worked. But the two things worth noting: our debt to GDP at the time was a little less than 40%. Today, it's 90 odd percent. 98%, nearly 100%. And the second thing to note is that in the wake of that, and because of very high inflation at the time, the British government found itself having to fund debt, gilts, issuing gilts with coupons of 15% and over. That's where we're going. Now, just imagine what that does to US government finances. It is catastrophic. There's no other word for it. But that, unless there is some sort of wonderful change, is where we're going. This idea that interest rates are going down and all the rest, and inflation's going. I mean, as your viewer Bob said, this, I'm afraid, is what it's a misconception that the establishment has. Just the same as back in 1973, 74, the economists in this country had exactly the same misconception. Yet interest rates had to rise in order for the government to fund itself, leading to coupons of as high as 15.5% on a 1998 maturity gilt. I mean, that's what we've got in prospect.
No, it seems like other nations around the world are looking at the West and, very concerned about these developments. We're seeing, the expansion of the BRICS, and one viewer is wanting to know about a latest development in this, where Putin is visiting Saudi Arabia along with the Russian central bank president there. So your perspective on that, this latest development of, I guess, this partnership between Russia, Saudi Arabia. Saudi Arabia is becoming part of the BRICS, and obviously, these nations are the BRICS. A lot of the BRICS nations are obviously accumulating a lot of gold. So what is your take on this latest development here?
Well, I mean, the oil story is more OPEC plus, I think, rather than BRICS as such. I mean, BRICS is probably relevant in the sense that the members of BRICS are moving away from using dollars in terms of settlement for oil and gas. So, but I think, BRICS is interesting. There are two things happening. One of which, of course, we've known for some time, and it's going to become very real very shortly. And that is that you've got new members joining BRICS. And the president of BRICS the chair will be held by Russia from January the 1st. Or what that means is that Russia will control the agenda. And I think you will find that moves towards more stable currency settlement, which basically means currencies, the settlement, should be linked to gold, which the Russians were trying to push, but never made the agenda before. But now that Putin will be president of BRICS from January the 1st, you can be sure it will be on the agenda. So that, I think, is the relevance of that. But there's also a news story coming up on the rails rather fast, and that is the newly elected president of Argentina has stated from the outset that he's backing off from China, et cetera, et cetera. It's difficult to see quite why he's taking that line. I would say a more considered view on this, if I was in his shoes, would be to account for the fact that China very kindly bailed out Argentina from an IMF loan about, I think it was 3 or 4 months ago. Like China made the dollars available. So they were effectively replaced an IMF loan with a loan in renminbi. So that is one thing. Second thing is that the rest of Latin America is moving towards a greater relationship with BRICS if they're not actually joining BRICS itself. So Argentina is becoming the odd man out. It's her move towards currency stability is to adopt the dollar. Now, I think it would be wrong to say that to abandon the peso and go for the dollar is jumping out of the frying pan into the fire, because obviously the peso is, considerably worse than the dollar is and is likely to be, I would think, in the short term anyway. But I just wonder whether there is a political backing to this, and that is that we could well find that the American administration very quietly is pushing Argentina away from BRICS in order to try and create division, if you like, amongst the Asian hegemons and amongst other countries sort of thinking, well, BRICS is all very well, but look what the Americans are doing with Argentina. It's very, very subtle, and we just need to be a little careful on this. Do you see what I mean? It sort of maybe introduces a note of caution. So those are the things I think I would look out for in 2024 when it comes to BRICS.
Now, we have another viewer wanting to know about fiat currency. You've said before that all fiat currencies collapse, but it seems like obviously some of these nations have been buying gold pretty aggressively. The viewer wants to know what your take is on the idea of Russia or Singapore with very little debt. Could they back their currencies by gold?
The answer is yes. If you know how to do it, it's actually extremely simple. The way in which this is done is you ensure that your gold reserves are stable by setting your interest rates to ensure that your gold reserves are stable. Now, that's a complete volte-face from the idea that interest rates should be set to manage the economy. No. It should be to set your gold reserves. Once you realize that, I mean, put it in the Russian context. Russia has a certain amount of gold. I think her official reserves in the order of 2,300 or something like that. But also, like China, Russia has gold in other state accounts. There are two accounts in particular. Sort of one's a specific precious metals fund, and the other is a wealth fund. It is believed, while this hasn't been officially divulged, it's believed that they've got a further 10,000 tons or so in those two. So that, Russia is in a position where with its central bank reserves, it can actually mobilize enough gold backing, more gold backing than America declares at 8,130 odd tons. So it can do it. Now, the other thing to bear in mind is that with interest rates in Russia currently around about 15% or something like that, from the point of view of a Russian bank, and they would be steered in this direction, what they could do is they could walk into foreign markets, say in Dubai, buy bullion, where the interest rate on the leasing of bullion is in the order of 2%. I mean, they could just lease bullion if they want, is in the order of 2%, push it into the central bank of Russia, and get 15% on it. Now, that 15% under a gold standard is effectively 15% in gold. So that's why you use interest rates to create the arbitrage to maintain your gold reserves. Russia is in a position where she can do that tomorrow. And indeed, senior economists in Russia have already made this point. So I think that's absolutely clear. Singapore is, I think, very interesting because the Singaporean government has got extremely good intelligence about Asia, about global trade, all these matters. And as a small island state, it's sitting there knowing what's going on in a way in which we can just not really appreciate. The fact that she is accumulating gold, and really quite aggressively, I think gives us a very, very good message that the days of the dollar are effectively numbered. And I think this is being echoed in the gold acquisition policies of other central banks, not all of them. But you can see that how other central banks are deliberately building up their gold reserves. And I feel sure that if there was more bullion available on the markets, which there isn't because the markets are very tight, if there was more bullion available, it would disappear into the central bank's coffers. They would be accumulating it even more rapidly. The only reason they're accumulating as much as they do is because that is the only gold that is available. It's not enough. For many of these countries. And of course, there's some idiots like our government who sold it all out, sold all out by 310 tons at something like $250 an ounce, And have they ever gone back into the market to replenish the situation from that obvious mistake? No, not so far as we're aware.
Now we have a few viewers' questions here on the banking system. Before we let you go, I did want to address that. Obviously, back in March and April, we had concerning developments in the banking system, banks going under or being taken over. Here in the US, we had Credit Suisse being taken over there in Europe by UBS. Your take on the current state of the banking system, and this viewer is wanting to know, do you think the US authorities could bail out the too big to fail banks if they were to get into trouble?
I think the answer to that is very simple. They'd have to, because if they didn't do that, the global banking system would simply implode. And this is what I mean about, the importance of understanding the difference between credit and money. Money being physical gold with no counterparty risk. Credit always has a counterparty risk. Now, whether that counterparty risk is a commercial bank or whether it is indeed embodied in the currency issued untied from, with no commitment at all to exchange that currency for gold coin or gold bullion, it's irrelevant. We're looking at credit collapsing. And there are two routes in which this can happen. One is that, you just stand back and let the banks all fall over and the economy fall over and all the rest of it. And that destroys the credit. That obviously that's not going to happen. That's not what governments are elected to do. That's not what the central bank's duties are. It has a mandate to oversee the banking system and ensure that it doesn't impart risk into the broader economy. The other way of doing it, of looking at this, is that as banks do get into trouble, as malinvestments begin to be unwound. I mean, I'll just tell you a little story about that in a moment to illustrate the malinvestment thing. But as they're unwound, then it's going to be at the expense of the currency. The currency and bank reserves reflected on the central bank's balance sheet will expand very, very rapidly, undermining the purchasing power of the currency. So, you have, one way or the other, you end up with the same result. One just happens a bit more quickly than the other. The point about, and this is something which I don't think has been really written about too much. The point about malinvestments is that it's now spread a long way beyond, just basically, sort of investments which never were sensible in the first place and have turned out to be dead ducks. And it's just tying up national capital, which should, as Schumpeter put it, it's the sort of creative destruction process that's been stopped. So the whole thing is sort of in limbo. But in this country, we have water utilities which were denationalized under Mrs. Thatcher quite some time ago. Now, over the course of time, of course, to sort of allay public fears of private ownership, because, the public has this ridiculous idea that, companies, are completely irresponsible. I mean, the answer is they're irresponsible if governments let them be and say, pay them money to be irresponsible. In other words, if the customer isn't king, companies are irresponsible. Customer must be king. The whole point about the denationalization of the water companies was that regulations were then put in place. And guess what? These regulations basically insisted that companies invested so much in infrastructure and all the rest of it. The regulator controlled the prices they could charge for water. They would have to get permission for increasing charges in water and sewage. But, of course, the way in which this works was quite simple. At the end of the day, a utility like a water company would be permitted to earn a profit of around about 7 or 8% set by the regulator. So it was almost guaranteed that it would earn that. So what happens when interest rates drop towards the zero bound? Well, you can see that private equity gets involved. Big private equity consortiums come in and they leverage up this so that instead of 7 or 8% return, suddenly they're making 40% because they've leveraged this up. And of course, the banks are quite happy at the time because they think, well, this is a very stable source of earnings. It's guaranteed by the government regulator. So what's not to like? But when interest rates suddenly rise to 5%, 6%, what happens? This then is a malinvestment, and it's throughout industry. This is very, very concerning. The whole of the private equity industry has basically had its legs cut off by this rise in interest rates, and nobody understands it. They understand commercial property where you've got, let's say, a yield and a capital value, and you can borrow against the capital in order to increase the apparent yield. And that's all, commercial real estate's now in trouble. And, we understand that. But don't stop there. The problem actually goes far deeper into the whole of the private equity thing, the whole of this idea that you can enhance the earnings by leveraging up a safe income stream. That has just been killed. This has enormous consequences going forward.
Well, Alasdair, it's always a pleasure to have you on, and I know our viewers appreciate you answering viewers' questions here. We couldn't get to them all today, but we really appreciate your time. If our viewers are interested in learning more, where can they find you online? And did you have any last thoughts for our viewers?
Yeah, you find me at gomoney.com. I publish an article every Thursday. Here we are, Wednesday. The one that will go out tomorrow is all about debt traps, which we've been talking about. So I would urge anyone sort of maybe not quite understanding what I'm saying or worried about it or disagreeing with me, go to Go Money, have a look, and you'll find the article there. And I also do a market report on precious metals, which goes out on the Friday. So that might be of interest to your viewers as well.
Well, this will be posted Thursday evening, so we'll put a link in the description to your latest article there on Gold Money. And yeah, thank you so much, Alasdair, for your time today, and God bless.
Very much my pleasure. Thank you for having me on, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.